staff is concerned, to our consultants from RDG Planning Design out of Omaha, Nebraska. These folks have been in the community several times over the last almost 8 months now, 9 months, and they've been talking to many of you already. We understand that. Some of you they've not been able to talk to, so your input today is going to be very vital to what we do with our final plan. We're going to expose to you a draft plan today and get your input and feedback, and then we'll go back in and finalize a plan and work with us on coming up with the next steps. So we hope that we'll be working on housing issues within our community. So thank you again for coming. There's some snacks and cookies and stuff like that for the time being to get you by. We plan on breaking about noon, somewhere in there, for about an hour or so. We'll see how that works out and come back for lunch for an afternoon session. There will not be a repeat from the morning session to the afternoon session. We anticipate that all 85 pages of the plan you have hopefully looked at or at least breezed through, or some of you have read the whole plan, I know. I've already talked to you about that. So we appreciate that. The plan will be online. It's still online on our website. Any changes will be updated as we go through that process, and we get those from RDG and we work from there. So please, your input's going to be very vital today. But our goal is within a 4-hour period to have some type of plan of action when we're completed at the end of the day to know where we need to start moving in the next few steps for our housing within the community. I'd like to introduce Amy Hussey and Marty Schukert. They are with RDG Planning and Design out of Omaha, Nebraska. They are the main developers of the project. You will not see staff input, but in minor areas to kind of give them some focus on some ideas of some things to look at. They've completed focus groups where we've had about 9 or 10 different focus groups came into this chamber right here and talked to them about some different ideas and different thoughts about housing. We have gone out to the community in 3 different areas of the community and took input from them. I think the largest group was in the North Salina group. We had 22 dozen or so people there. The others we had anywhere from 12 to 15 of the other groups. So very pleased about the input throughout the community. Once completed and the plan is all done, we hope we'll have a game plan that we can start working on various housing issues within our community. So if you know somebody else that would like to talk about housing, text them right now, have them come on down. We do have some extra chairs now, and hopefully we'll get it set up. So I'd like to introduce Amy and Marty, and they'll be talking to you about the housing plan. Thank you.
Thanks, Gary. Well, first of all, we are very excited to see this many people here. When we walked in the room, we figured, well, we'll just kind of set up a little conference table and do this in just a collaborative few hours together. It would take a very big conference table, but view this as a conference table. In other words, we have PowerPoint slides, but it is not a PowerPoint presentation. These are aids that will help us explain things and provide a basis for discussion. You will not see fancy animations or people popping in from above on the top of the screen or any of those kinds of things. First of all, can everybody hear okay? Okay, great. Just in terms of the assignment of looking at Salina from a housing policy, market, and strategy perspective has been a very interesting project, to say the least. We know that there's been a good deal of controversy about very significant issues of how the community should grow, how development should be financed, what kinds of investments need to be made, and those have really challenged us, and we have taken some time, and maybe a little bit more time than we should have, to try to make sure that we got it right and provided you with the best and most creative ideas and directions that we can. We appreciate everybody who has talked to us over the last few months, who have come to sessions, who have come to meetings and so forth, and hopefully they will see their ideas and input and incorporated into this plan. This document is not meant to be non-controversial. There are things in it that people may not like or may not agree with. But we figured that the reason that you hired us or hired consultants in the first place was to be honest, at least from our experience and our perspectives, and to give you an honest analysis of the city, its housing and development situation and challenges, and to give you ideas that are ways that we think you can move forward. It is not essential that everything will be done. We don't expect it will all be done. Some of the things are suggestive. They're ideas which may not be implemented exactly as we've proposed, or even exactly in the places that we've proposed. But it's really the process that becomes very important. So don't look for this document or this presentation to be to shrink from controversy. It's not intended to do that. It's intended really to challenge, to present ideas, and to engender discussion. That gets to the next point, and that is that even though this room is set up in kind of a presenter lecture sort of format, we don't want it to be that. So if you see something that you'd like to comment on, or raise a question about, or ask us about, please feel free to do that. That will provide the best the best kind of exchange, and be the most useful to us as we use this information and this discussion to finalize the plan and to move forward. As Gary said, the afternoon session will not be a repeat of the morning session. It will be completely different and logical material. So see this as a 4-hour get-together with a break for lunch in the middle, and probably a couple of breaks for other essential purposes in the middle as well. But we really invite your thoughts, questions, requests for clarification, anything like that, so that so see this as a more of a symposium than as a presentation. That said, I'd like to give you a little bit of an idea of the material that we'll be covering, or that we'd like to cover together today and to walk through with you. First of all, we would like to summarize some of the market and statistical highlights of the plan, because one big element of our effort here has been to quantify housing needs in Salina. How has the community grown? How much housing does it need? Where do those needs seem to be lying? Amy is going to lead us through that process. Then we're going to talk about overall policy. And this gets heavily into the issues that have been significant in terms of development finance, the use of special assessments versus private financing, the sort of an analysis of where we think the general policy brushes and parameters of the city ought to be. And I'll lead that discussion. And then finally we're going to talk about what we call beachheads. These are pilot projects or pilot strategies that we think can be very influential in terms of specifically redeveloping and reinvesting in existing neighborhoods. The beachhead analysis you will find will be, and I won't be giving you a spoiler alert, will be very heavily concentrated on North Salina. That we believe, and in conversations we believe, you believe, that North Salina really is a very critical focus area for a number of reasons. And so as we think about this idea of beachheads, North Salina involves a very substantial part of the concentration. Again, you'll find, I'm saying this so that people don't wander off after lunch, because it'll probably be after lunch when we get to it. But I think you'll find the directions that we could go through or go in North Salina to be very interesting as well. And then finally, talk and lead an overall discussion about next steps, about the things that we need to do as a community to move forward on these policies. So again, please feel free to comment, to ask questions, to ask for clarification as we talk about Salina housing and development in the city. Again, thanks to all of you for coming. we're really excited to see all of you here and hope for a very fruitful day together. So Amy, take it away.
You know, I will add also that it was, Gary mentioned and Marty mentioned all the conversations that we had. We also did an online survey, and I believe we had over 800 people complete that survey. That is an outstanding number, and you should all pat yourselves on the back for getting the community that engaged. I actually use you now as kind of the challenge city when I'm working with other communities. Salina got to 800, you can do it too. So,
Yeah, you
job,
get beyond
everybody.
25.
Yeah. So great job there. I always joke that I think it's my background as a history and social studies teacher that to understand where you're going, you've got to understand where you've been and where you are today. And so that's kind of the first part in the analysis that we begin to do of understanding where our demographics and economics have been and where we are today. Over the last 4 decades or so, Salina has experienced pretty steady growth. So everybody knows, I believe in the 1960s is when the base closed and you saw a big drop, but you bounced back quickly, and since that bounce back, you've seen kind of this steady growth pattern. We always think it's probably helpful to understand, well, how does that kind of begin to compare with other communities and other cities in the region? So you're fairly comparable to a lot of other communities in the region. Emporia has been seeing declining population, and so has Leavenworth. And I think those are probably the 2 more comparable cities to you in this list, because Lawrence and Manhattan, as university cities, you will see in some of the numbers as we're going through here, that does begin to skew their numbers a little bit in different ways, and we'll talk through and kind of explain what's been happening there. But you did see about, if you can't read that, you saw about a almost 4.5% increase in the 2000s. Go ahead. We like to take a little bit closer look at what's actually happening within those populations. We call them cohorts. We break them down into 5-year increments, 0 to 5, 5 to 10, and so forth. What we do is we do an analysis that says if nobody moved in or out of a city and the only thing we had happen were births and deaths, what would happen to your population? And it's what we call the predicted population. So the predicted population is the outline, and the blue color is your actual 2010 population. So what that starts to tell us, and I've circled it here, grab that. So what that begins to tell us is here in those cohorts, starting at about age 30 to about age 49, what we saw here was the predicted population. What we thought was going to be here in the community was greater than what was actually here. So that starts to tell us that you probably saw out-migration among those cohorts. This is important because these are cohorts in your childbearing years. What saved you, and we've seen this across Kansas and Nebraska and Iowa, and the statistics have bared this out, is we have a pretty high birth rate in the 2000s in all of those states, and you definitely see it here. So even though you saw an out-migration, the ones who stayed were having lots of kids.
Although it's interesting that that's pretty close to predictions.
Yes, yeah, it is pretty close. And you saw you were pretty good at probably attracting seniors. And we think there's probably, and we'll talk about that here a little bit later, but we think there's probably a pretty good potential of attracting more of that population. How did that begin to correlate to construction activity that we saw here in the last few decades? So this is probably why I need to sit, because I kind of block the people on the sides, don't I? Like every community, we saw the numbers begin to drop in 2008 and 2009. For a lot of communities, this started to pick back up. You picked up a little bit, but you've remained, again, fairly flat. In 2014, you only constructed 54 single-family units. So that number for your overall population is still fairly low. Marty, can you go to the next slide,
sure.
please? We also take a look, and I think this is really interesting, and one of the reasons why I wanted to show you the construction activity before I showed you this. This is occupancy change. So between 2000 and 2010, we added about 165. This is the Census Bureau information we get from the Census Bureau. So we added about 165 owner-occupied units, but we added 703 rental units. But we could see from our construction activity, we didn't build 700 units in that time period. So where are those units coming from? Well, they're coming from a single-family home being divided up into multiple units, or just a small single-family home being converted from an owner-occupied to a rental-occupied. We've seen this in a lot of communities. My description of it has started to turn into, over the last 15, almost 20 years, across the Midwest have placed a lot of our rental demand on the backs of our single-family homes because we have not been constructing new multifamily structures. And this really points that out when you look at that number as compared to what you were actually building during that same time period. So where do we think our population could be going in the future? So we did a few different scenarios here. The first scenario says, what if we grew at a 0.2% annual growth rate? That's actually what you grew at if you averaged out between 1960 and 2010, that 40-year period. So that's this bottom line here. The next line up is that natural population. What would happen to your population if you just had births and deaths? You have a young enough population that you will have a higher birth rate than you will have a death rate, so you would continue to see some growth if that occurred. Well, what if we could be around a 0.5% annual growth rate, which is it's a little bit more than what you experienced between 2010 or 2000 and 2010. So if we grew at about that rate, we would be at about 54,000 population by 2035 in a 20-year period. And then we also took, what if we had a little bit more aggressive, just to show another alternative, where would we be at if we were in a still less than 1% annual growth rate, and we would be up closer to about 58,000 people in that 20-year period.
Yeah, and I would add to that usually in the practice, when you're looking at a growing non-metropolitan city, a city that is a standalone city like Salina, it's not usually out of bounds to talk about a 1% annual growth rate. That's kind of the standard measure that you think about. We haven't grown at 1% for some time, and we think that's probably not a realistic projection for the next 20 years either. So a 0.5% seems to be to us a pretty reasonable target population that provides for reasonable in-migration and reasonable economic development, but nothing that's crazy or that assumes a gigantic industry is going to come and employ hundreds of people.
Right, exactly. Right, so what does this begin to look like if we want to convert this into housing demand? If we're just saying we need to provide housing for this new population, we probably need to replace some units. What does that begin to look like? So what this table tells us, the first line here is our population projection, the number of people living in the household. So we always have a certain number of people in our communities who don't live in households. So people who live in skilled nursing settings, dorms, jails, so forth. They don't demand housing in our community in the traditional sense. Our average people per household. So we have the number of people who are living in households. We have an average number of people who occupy those. We kept it at your level that you were at in 2010. So what does that create in a household demand? Well, it creates about 20,600 or so housing units. But we have some vacancy rate that we have to factor in there. A good vacancy rate is probably between 5% and 7% for a healthy market. And so that's about where you were at. We saw that staying even. We also saw a need that you were going to have to replace some units. You were going to be seeing some units leave the market. Why do units leave the market? They're demolished. That single-family home that had been converted into a multifamily home, maybe somebody converts that back to a single unit. That means you maybe lose 1 or 2 units when that happens in your market. What this averages out to is a need for about...
That's probably a low number.
Yeah, it's pretty conservative. We were fairly conservative in this number of the replacement needs, but also the total demand. Yeah. And so you were at about 116 units annually. keep in mind, in 2014, you were building, I think of a total, you were less than 60 units, or right at around 60 total units. So this would be a significant increase in your production that would need to occur to replace units and to meet any population growth.
Now, the problem you could ask is, what's the consequence of not building to the demand, which we're not doing in Salina right now. It doesn't necessarily mean that people are out in the streets, but it means that their specific housing needs are being met in ways that we don't necessarily want to see. That is, as Amy was saying, subdivision of single-family houses into multiple units, maybe 2 units, maybe 4 units. Units that really shouldn't be on the market, that are substandard, staying on the market for longer, for a non-competitive situation, sometimes producing higher rents or higher housing costs, but more usually higher rents than people can afford. So none of these are necessarily things that we want to see happen, but they're the ways that a market that isn't producing enough new development adapts to housing demands over the course of time.
So we've established that in the next 10-year period or so, we're going to need about 1,100 to 1,200 additional units. So the next step for us is to begin to understand where should that be kind of breaking down income-wise and cost-wise. And so we took a look at what's happening in our economics and our household economics. Again, here, we think it's always kind of, I think, interesting to see how are we doing in the larger market, in the larger region. So this takes a look at median household income between 2010. 2010 is the blue, and the black line, if you can see that, and the percentage is the change from 2000 to 2010. So median household income, you're very comparable to Leavenworth and Lawrence. Leavenworth is actually above you, which is interesting. They've been losing population, but it might be a little bit of their job makeup. Emporia is below your median household income. You're student, and then you're above, you're slightly above Topeka. Lawrence and Manhattan, this is where it always gets interesting with the student populations. Often student populations pull down median household incomes because they're either not making anything or at least heavily subsidized by somebody else.
Yeah, their parents don't count.
Their parents' incomes don't count. But this is also, you'll see this in a few slides, they put tremendous pressure on a housing market. And so we'll see what that effect has on some of the housing costs.
Yeah, a thing to point out is that these are actual census numbers, and it's not real income growth. It's not inflation adjusted.
Right.
So it means that our annual incomes might be increasing at a rate of about 1.4 to 1.5% per year. An inflation rate of 2% on the average means that real income is less than it was in 2010 than it was in 2000.
Right. And that's very important because at the same time our housing costs
Are going up.
Mm-hmm.
Any questions so far? Is this all? Hopefully it's halfway interesting, but it helps to set the stage.
I always find it very interesting.
Yeah.
I'm always amazed
We
when I
have
get
to.
these glassy eyes. Wouldn't find this interesting. Also, I think the educational piece, because this tells us a little bit about potential income earnings within a community. So in this, the first on the left here is Salina. The one on the right is Kansas as a whole. So overall, you have a greater percentage of individuals who have some college and no degree and just a high school diploma than the state as a whole. You have a smaller percentage of those individuals with associate degrees to higher education. So that tells us a little bit about earning potential and what sort of market demand that begins to create for housing. I mentioned a little bit about then looking at housing costs. So the first column here is our median household income that we saw the chart earlier for. The next column is median home value, median house value. So in Salina, I believe this might actually be, oh no, it is 2010. Sometimes we have some more recent, what they call American Community Survey data, but So we took a look at what is your median household income. Again, very comparable, a little above Topeka, well above Emporia, but below Leavenworth in those median home values. Manhattan and Lawrence are significantly higher, and that gets driven by the college market and the student demand that they place on the housing. In Manhattan, you also have Fort Riley, so we get a lot of, especially the officers who tend to live in Manhattan out of Fort Riley. So that begins to drive up the housing costs. The next column here is what we call a value to income ratio. So it's a ratio between a household's income and the median home value. What we're looking here for is that kind of rule of thumb is that affordable housing, that 30% of household income in this ratio should be somewhere between about 2 to 2.5% of the household's income. So when ratios get below that, below 2, that's not good. And when ratios get into 3 and above, that's also not good for a market. So why these two? Well, obviously when they get above, that means your housing's pretty expensive. So you see that here in Lawrence and Manhattan. Their housing is very expensive as compared to median household incomes. Why is it bad on the other side of the spectrum? Why is it bad to have below 2.0? Because that tells us that the market is undervalued, housing is undervalued, and it makes it a much riskier market for people to go in and invest in new construction or in rehab. If I go in and do that, am I going to be able to get my money back out of it? Am I going to be able to get the value that I put into it back out? And so it becomes a much scarier market and can really hamper reinvestment in a community. We included this analysis at the kind of a census block level also, and we saw neighborhoods in Salina, especially North Salina, where we did see those numbers. I put a few maps in here, but I knew the maps would get really hard to read, so these are all in the document online if you look at it there. But we did see, especially in North Salina, some of those ratios below 2. So that's telling us that those undervalued markets, and we'll talk a little bit more about this later, begin to make it really scary to make investments in certain neighborhoods.
Just to try to put the value to income ratio, which is a number that we find to be very interesting, into perspective. Generally, when we see a situation where that number falls below 2.5, that ratio of median value to median income falls below 2.5, it suggests a market or an area where housing is relatively undervalued. That is, it's not really sustaining the overall value of the community. It gets worse, obviously, as it gets farther down the scale. If it's between 2.5 and 3, it's really kind of the sweet spot. It's sort of where values are high enough to have a self-sustaining market, but they're low enough to be affordable, and most people's housing burden is not that bad. When it gets above 3, it starts to get a little bit more pricey, and people's housing burden, the amount of their adjusted gross income that they pay for housing, tends to start rising above the 30%. It's kind of the magic figure. It was very interesting. This is kind of a digression, but I saw this ratio calculated on a nationwide basis for the period between 2000 and 2010, and you could see the number going up, and then right around 2006, 7, and 8, it did that. That was the housing bubble, and you could see it very graphically in that number, and then it came crashing down. So we want to see a number that's more or less in this 2.5 to 3 range on an overall basis. When it gets when it gets below 2.5, it means that we've got to try to build value in the neighborhood. And as you'll see in some of the later discussion, a lot of what we need to think about in areas like North Salina is actually increasing the value of the neighborhood to the point that the real market starts to work again. Interest rates from from my perspective, over the last 5 years have been artificially low. I think we all know that. You know, we've got the Federal Reserve basically giving money away and not charging interest in order to stimulate the economy. That is not a normal situation. So when we do our calculations, we calculate the payments. It's something that's what we would consider to be a more normalized interest rate. That'd be something on the order of 4 to 5% for single-family mortgages. Now, very interesting thing that when I became community development director in Omaha in 1980, we were dealing with interest rates that were in a 17, 18, 19% range. If you can imagine that. We used to put a ton of community development block grant money into projects to subsidize mortgage rates to 6%. If we had 6% mortgage rates now, people would freak out and the entire market would freeze up. So, you know, we've gotten unfortunately very addicted to very, very negligible interest rates. And we think that that's been very nice for a number of years. But I personally am afraid that when the Federal Reserve begins to adjust interest rates upward, as they inevitably have to do, that people are going to freak out and there's going to be a real dislocation for a couple of years until people get used to it again. At any rate, when we calculate affordability, we assume an interest rate in what we would think as being a more normalized category. Obviously, when interest rates are very, very low, they allow you to buy a bigger house or a more expensive house than you might normally be able to buy. Yeah, that kind of rule of thumb that I've been using of like 3 times is based on a relatively real interest rate. So yeah, right now the monthly payments are rather cheap if you can get financing. We've had this paradox within the last few years of money being cheap but very hard to get, which is very weird. But you know, that's the cycle we've been in since '08.
The next chart goes into a little bit more detail. It might have been the one that a lot of people caught a little bit more on the affordability side. And what this chart does is it begins to look even closer at our income ranges and where our housing is today as it relates to those income ranges. So I find that a lot of times just stepping through this, going across this chart really helps people out a little bit. So the first column here is our income ranges. So if a household is making between $25,000 and $50,000 a year, in Salina we have about 5,800 households that make that income. An affordable unit, as Marty said, at about 2.5 to 3 times would be between $50,000 and $100,000. Or 2 to 2.5. We have about 4,000 units that the census says fall within that price range. For an affordable, figuring that 30%, this is the rent and other costs related to your housing on a rental unit, would be $400 to $800 a month in rent. We have about 46, I guess I can step back here, I have a laser pointer. We have about 4,600 units in that range. So we have about 8,600 units that are affordable to households making between $25,000 and $50,000. We have about 5,800 households in that range. So that tells us we have an extra 2,800 units in that area. So these areas in pink tell us where we have some of those shortages. You will notice.
But let me just add one other thing, and that is that when we're calculating affordability, we're factoring in utilities, principal and interest, and insurance costs. So all of those things that relate to the fixed cost of housing are in the 30% range of a person's or of a family's adjusted gross income. So when you take a basic housing price and then add in these other costs, that's all related to whether that unit is affordable or not.
So you will notice here probably our biggest deficit of affordable units is for households making less than $25,000. We have a deficit of 2,900 or so units there. So that looks like a huge number. It is a big number. As Marty said before, are those people living on the streets? No, they're not living on the streets. There's a couple different things going on here. One, we've got a number of households in this income range that are probably seniors living on fixed income that own their home outright. They're not paying on a mortgage, so so they're not demanding a unit, and they're not feeling the squeeze of high housing prices. But we also probably have a number of people in this area who are paying more than 30% of their household income to cover their housing costs. So those are kind of the two big factors. They're probably down here filling these $400 to $800 units is where they're falling, a lot of them. We also have a number of households that make over $100,000 that are living in units that are pretty affordable to them. They could, if they had the option, or wanted to, they could move up into something a little bit more, a little bit higher price point. What's really important here is the fact that what we were hearing in a lot of conversations was this kind of sweet spot of, boy, we would love to have more houses on the market that were probably between 100 and 150,000. This says we have about 300 extra units in that range. That's not much of a surplus. That's pretty tight, especially when you start looking down here and you look at, we have a negative of 320.
Yeah, they're living in those.
They're living in these units. They could afford higher price point units. They could afford units priced over $200,000. But they're living in these price point units of the 100 to 200,000 because they can't, those options aren't there for them. This also gives us a sense, I mentioned the sale piece. We were able to gather some data on median sale price over the last few years. Again, as I mentioned, and we heard this in conversations, that kind of ideal spot of 120,000, that was the median sale price. That's what, there was a lot of interest on the market. Sales numbers have kind of fluctuated. We had the higher number in 2013 than 2014. And maybe some of the realtors would, as we're getting closer to the end of the year, our numbers are up or down here in 2015. I'm guessing there's been a lot of demand for those units still in that $110,000, $120,000 range and being a pretty competitive market.
On a citywide basis.
Yeah, on a citywide. Mm-hmm.
And it's gone down.
Yeah. So how do we begin to break this out? If you remember, I mentioned over a 10-year period, we had a demand for about 1,100 units or so in the market, 1,100 to 1,200 units. And so we said, well, if we broke these down into price points, where would we begin to see the demand? We upped the percentage of renter-occupied units. Remember how we talked about, or I shared, you really weren't building much in multifamily. It was going a lot to the single family. Again, we've seen this across the board in about every community we've worked in. So we said, well, your percentage in the next few years of new residential or new renter occupied needs to probably be a little bit higher than it has been in the last 15 to 20 years. So if we broke that out over kind of 5-year increments, where would we be beginning to see the demand? We assumed that a lot of the households moving into the community would be in the same kind of income ranges that we see today. We have to kind of make that assumption. So we continue to have pretty strong demand for those affordable rental units, and again, strong demand for those units kind of between the 90 and 190,000 are again in great demand. We will probably not see construction of new units though priced below 125,000. You really, unless you have a pretty heavy subsidy, you can't really construct something new in that price point. So where do those units come from? They have to come from our existing housing stock, through rehab, through opening up units that we have in the community today. We often describe it as your best source of affordable housing is the housing you already have in your community, and making sure that stays vital, healthy housing stock that can be filled by this demand that's being created. And that we have the options for move-up housing, that people can open those homes up with.
Yeah, well, one comment is that, you look at this and say, well, that seems like a lot of rental housing being developed. Keep in mind that we have had a significant increase in rental occupancy over the last 10 years and not very much rental production. So clearly what's going on is that single-family houses are getting converted to rentals. That has a pretty negative effect in a lot of ways, because renters generally don't take as good care of single-family houses as owner-occupants do. Those units, those house structures don't adapt as well to rental occupancy. And we're seeing that, honestly, in a lot of neighborhoods where there are deteriorating conditions, and you really suspect that those are because of increasing rental occupancy. Again, that's because we are in Salina and around the country experiencing a great increase in rental demand for a variety of reasons, and not necessarily building the as-built rental supply that's designed for those specific occupancies. So as a result, they're getting reoccupied, they're converting, and that does have an effect on neighborhoods. So the numbers that you see here really are based on real rental demand, and are saying if we build different kinds of rental forms, including hybrid forms that are rental units that build equity, and we'll talk about that a little bit later, that then opens up existing housing to re-occupancy by owners, and thereby strengthens single-family neighborhoods. So again, even though it looks so, you look at this and say, well, gee, we wish we should be building more owner-occupied housing. Yeah, we should, and we're not building to demand there either. But a certain amount of rental production is really quite important, so that we're not putting excessive amounts of rental housing into housing units that really are not built for rental occupancy, that ought to be more owner-occupied.
Yeah, I actually have a kind of an interesting side story. So in Omaha, I live in a neighborhood that's a 1920s neighborhood, and we have a sprinkling of homes that have been converted into rentals. A developer has bought a piece of property on the edge of our neighborhood, Bluestone, and is looking at doing a project. And and I said, I'm excited about this project. It's going to be a nice quality project. It's going to be well managed, and I would much rather have the college students and the med center students living in this nicely well managed project than in my rental house down the street that I'm not sure who owns it or where he lives. So I was all pretty excited and supportive of it. And
you're probably the only one, too.
Actually, I had the rest of it. I was, it's the problem of having a planner in your neighborhood. Okay, so the other market that I mentioned a little bit about earlier, too, was that opportunity for the senior housing market. In our conversations, we heard a lot of, we think there's a lot of potential here to tap into the senior market, not only to attract seniors to our community, because we've got great resources, we got the services and the amenities that seniors might be looking for, but really for a senior here in Salina who maybe wants to downsize, wants to go to something that's lower maintenance, there's really not a lot of options. It's pretty tight. And when you look at that market and say, hey, we just got done talking about this interest in trying to open up more housing in that $125,000, $150,000 market, this might be a key demographic that if they had an option, we now have a nice single-family home for a young family to be moving into. So we did a little bit of a calculation, taking a look at what we might be able to capture. We were pretty conservative at assuming a 0.5 to 1% capture rate of those households. We know you're not going to, a lot of people, they live in their home, they love their home, they're going to stay there for the rest of their life. So we're not going to assume that we're going to capture a huge number of those. But we could capture possibly 88 new households or existing households. This looked at the county as a whole. Usually when we look at senior markets, we look at a little bit bigger than just the community itself. But even if we said we took half of those who are living here in Salina today, we could open up 44 additional housing units within the community back to those existing units, affordable units that we have here by providing that as an option. So we wanted to kind of show that and demonstrate that there is a potential there for that market to capture some of that. So any questions on the demographics, the economics? I'm going to talk a little bit next about some of the information we gathered at the neighborhood level.
No. I mean, money, it's interesting because around the country, the one area of housing that's increased in production is rentals, is new rental development. And it's a very interesting thing because that market between 2000 and 2008 died, except for low mod income development. There was tax advantage. Conventional market rate rental development was really flat or non-existent in most places. Why? Because generally people could, even if they couldn't be underwritten, they were still getting home mortgages, and we're getting over leveraged. So this market that probably should have been in rental units was in fact buying homes, and then things crashed. So now we went into a situation where a younger generation, a millennial generation, was now getting into the rental market, didn't really have confidence in homes as an investment, couldn't get underwriting for mortgages, and now gets pushed into the rental market. And after a couple of years, rental development began to attract that investment, and you would see people around, this is not Salina's situation particularly, but around the country, beginning to put money into rental development and to invest in new rental stuff as opposed to existing houses, although that's going on as well. What's happening in Salina is that for whatever reason, there's not a lot of new rental production. It just isn't happening. So the rental demand or the rental investment that we're seeing is getting plowed back into existing homes, and those homes are increasingly being occupied by renter occupants. One phenomenon that we heard about, say in an area like North Salina, that's something that we find to be a concern, is investor owners or investors buying up inexpensive houses when they come on the market and become available, doing a minor amount of fix-up, and then reoccupying those with renter occupants. So they're not really doing full standard rehabilitation. They're doing what Marty Feldman and Young Frankenstein would say, shag carpeting and throw pillows, and sort of fixing those up. But the guts of the home are really not in very good shape. The problem with that is that it's a good short-term investment, but from a public perspective, it's not a good long-term investment. That as you said, people hold on to those for a few years, make a profit, and then get out of the market because they're getting torn up. So one of the things we're going to suggest to you is a mechanism by which there's another market for those inexpensive, units when they come on the market, which we think an increasing number will as their owners age. And that is an acquisition, rehab, resale program. But that requires an organizational infrastructure that we don't have right now. That is somebody who knows how to do it. But we'll get to that later on in the session. But that real sort of I would say conversion of capital to buying houses and converting those to rental occupancy is as much, it responds to a market demand, but it's also the result of the lack of development of competitive new housing.
I will say that I would say we haven't seen it, especially in markets where you just haven't had any of that multifamily happening at market rate. We've seen a lot of the more affordable units being built, the tax credit projects in a lot of communities. That's all that was maybe getting built. So that more market rate units, it's untested, and so there was a gap there that needed to be filled. Exactly what you described, we've heard, especially in a lot of college communities, where parents went in and said, "Why pay rent? I'll just pick up a house for my kids." So it was something especially that we heard in like Maryville, where people were doing that a lot. And in a lot of those college communities where parents are going in and picking up a house and going, "I can make more on this, renting to some of my son or daughter's friends than I can later." Yes?
We do, yes. But just as they postpone the creation of families, they postpone marriage age and they postpone having children, they're also nationally postponing entry into the ownership market, but they'll eventually get there. Part of it is school debt. Part of it is not a lot of confidence in the quote American dream. I mean, not that they don't believe in America. Don't write. There was a reporter here taking notes. Don't write. So a consultant does not believe in the American. No. They're cautious about home ownership because they see housing as more of a consumable than an investment. And I don't know that except, honestly, in terms of rate of return in some markets like San Francisco, people have gotten rich buying and rehabilitating houses. In most markets, it's a modestly positive investment, but it's not an incredibly great one. You're living in a house because you're dedicated to it, you have pride of ownership, you want your own place, but you're not going to make a lot of money in it. So it's really a little bit different perspective, but I think that we will see that when millennials start thinking about having children, about schools, about settling down in a specific place, that they'll and hopefully capital and mortgages will continue to be available, that they'll begin to enter that market to a greater degree. Yeah, there will. I think that there will be, for the foreseeable future, a bigger rental market than we've been used to for the 20 years before 2008.
I will also point out one of the interesting things that we've heard. We heard it here in Salina. We have heard it in a lot of communities. That market, when they do go to buy, they're not looking for a fixer-upper. They don't necessarily want to go in, is what we're being told, and do a lot of major upgrades to the homes, which I find very interesting. So I think that's an interesting part, especially as we talk about policy and housing conservation and housing rehab, of how we get high quality units on the market and not needing significant rehab. The other thing that I thought was, it's an interesting little note, and I'm thinking about what millennials think of as housing, and it was a comparison I heard about between what they grew up kind of watching on TV as the ideal, as opposed to what my generation and the baby boomers saw as the ideal. And instead of the Brady Bunch single-family home on a nice-sized lot, they grew up watching people living in urban environments as that ideal. So it's an interesting kind of like social commentary, I thought, about what they idealize.
Well, actually, it's interesting because I think that one of the forms of rental housing that has sort of broken the barrier between what people thought were market rents in a community and what people are actually willing to pay has been downtown housing. And again, this is applied to both a millennial, what's driven downtown housing at higher ends are people at both ends of the scale. Millennials who want to live in an urban environment and like the idea of, are not all that interested in lawns, but at least at that stage of their lives, but like the idea of restaurants and coffee shops and entertainment and so forth nearby. Baby boomers who are looking, some element of baby boomers who are looking for the same kind of thing, have driven downtown and central city housing in a lot of in a lot of situations. We think that Salina, fairly uniquely among cities of 50,000, have a pretty good framework for that. Pretty good stock that's convertible, some projects and some project interest that's beginning to emerge. A strong downtown's got a really interesting mix of stuff, particularly for a city of this size, where in a lot of cases downtowns are pretty blighted. Great park nearby, entertainment in the area. That it's going to, downtown housing here, I think, is going to be the pioneer for market rate rentals.
Maybe already starting to
And
a little bit.
already starting, yeah.
Okay, so,
Amy,
yes.
Mayor Blanchard mentioned something about a chart that was in the handouts and stuff. It's not online at this particular time. We put on the probably the most outdated line we could find. No, the most recent was last Monday, Monday or Tuesday when we got the plan. And so some of the things that Amy and Marty are talking about today may be updated from what's online today.
Yeah, that information actually, it's a line in another chart.
Yeah, so it's in there, I just kind of reorganized it in the slide here. So some of them are the actual repeat of the table that you'll see in the document. In that particular one, I had kind of rearranged the information a little bit and made it a little bit more readable.
But it might be a good idea to call, it is an important chart.
Yeah, it is an important chart. It's in there. It has more information than I was actually just showing you on that. I was trying to make it a little less busy for the slide for you. Okay, so to talk a little bit about what the neighborhoods, we did an analysis of kind of the neighborhoods and what was happening across the community. When we started the process, we divided the community into kind of 4 areas. We used these tried to for our neighborhood meetings and tried to attract individuals from these different areas to some of the strategic meetings. We'll begin with North Salina. There's a lot of maps in the document. We tried to tell the story a lot through what we call kind of a series of atlases. So some of the things that we began to look at, and I knew these were going to be hard to read, so I wasn't going to go through and try and put these all up on the screen. But if you go online or you have a copy, you'll see them all there. Up in this top left-hand corner is median age of the units built in the area. So in North Salina, this is Iron, is our line here. So we have a lot of homes, 1930s, 1948. So on average, they are some of our oldest homes in the community. We also, the city completed a housing condition survey that we included here. So the red dots are kind of the housing in the worst condition. The orange and then yellow are ones that were noted to have some major repair needs that needed to be done, but not quite as structural. We also, your floodplain is a major issue for you, and where you can build and where you shouldn't build, and maybe where houses should or shouldn't be. We want to obviously avoid as much as we can any new building in those floodplains and avoid those areas. It's both safer for the people living in those areas, but also for the people downstream. The water's got to go someplace. And then the bottom right-hand corner here is mean appraised value by block. So the redder colors are the lowest appraised values, down to the yellow being the highest appraised values. So we have a lot of those reds in North Salina. It's important to note here that this includes vacant lots. So you will see some red down in new development areas because that's reflecting low value because they don't have a house built on them yet. They're a vacant lot. But you can see there's a lot of the darker colors here in North Salina with very little of the yellow. So what are some of the key salient points here? Well, this area lacks a lot of neighborhood services. We've just finally had the new grocery store. It looks like it's open, right? We were over there in that area this morning. It looks like that's opened up, so that has added a service to the area, but we heard that from a lot of the neighborhoods lacking the services, the schools, so forth. Housing, as we mentioned earlier, is undervalued in this area. So the home prices are very, very low, and which creates this perception often of higher risk. If I go in and buy a home and fix it up for myself to live in, am I going to be able to get my money back out on that? Would it get assessed at what it actually cost me to put into it? In the same way that if I wanted to build something near there, if I picked up a vacant lot and built a $180,000 home on that vacant lot, could I get that assessed at $180,000? What's my risk that I'm taking on there? So that often has hampered reinvestment in those neighborhoods because of the risk that individuals and investors and builders would fear they were taking. Next is Central Salina. Again, some of our older housing stock in this area. It's a little bit more mixed. We have a lot of 1950s era construction, but a mixture of, as we get closer to the downtown, those 1940s and 1930s era construction. Again, a lot of housing in these areas that do need some work. A lot of it is a little bit, it's not as severe, but a lot of kind of minor rehab and improvements that need to be done. We're starting to see a little bit more of the yellows in the assessed values, and you can see the floodplain issues that we also have to deal with within the heart of the city. So here as I mentioned, we also, or as Marty mentioned, we have some of the city's strongest assets in this area, mostly centered around the downtown as a real core asset that we can begin to build from. Housing condition is a little bit more mixed in this area, but we think there's a lot of opportunity to build on those assets that you have here. To the south, as we move south, we have some of our newest housing, a lot of this built in the 70s and 80s. We also have some of the base housing that had been originally built out here has gone through one rehab, but we also see some of those reds and so forth appearing. That's where you see the vacant undeveloped lots out there in a newer subdivision coming in as that dark red, and it's just because they don't have a house on them yet.
Yeah, no, the areas that aren't colored have higher values.
Right, well,
I think
yes.
they're doing. Is that right?
Right.
Yeah.
So in South Salina, we have some of our key retail and job assets in those areas. The market tends to be viewed as much safer and much lower risk with a higher return on our investments. And there's probably some more opportunities for new development. I didn't point out the floodplain map, but that's where we have probably the least conflicts with the floodplain is as we move to the south. So there's probably more opportunities in those areas for new development, and again, is perceived as a little bit lower risk developments. On the west side, again, east. On the east side, again, very strong market. We're seeing fewer of the kind of reds and yellows on the dots here in the housing condition area. So the area where we see probably the highest concentration is around Iron and Ohio, the neighborhood to the southeast. Again, strong market perception. We have some, again, safer, lower risk perception in the area. We have a few vacant and developable lots remaining. So it's perceived as probably the highest return on investment, the lowest risk, but we have the fewest opportunities probably for development in those areas. this began to, as we layered all of these pieces together, we started to look at different policies and strategies that we would have in the neighborhood and really tried to focus in on some target areas. We identified areas for neighborhood conservation, infill redevelopment, and redevelopment areas. And if you want to go to the next slide. So those neighborhood conservation areas in purple, those areas are where we have a pretty sound housing stock with the cluster of housing that's in kind of fair condition. Policies here should be really focused on those rehab and conservation, and we'll be talking more about those types of approaches that we can be taking here in a little bit. Infill and redevelopment areas, those areas probably have a little bit more serious housing condition issues, that we have a few more vacant lots. It's an opportunity, we'll talk about these beachheads, it's an opportunity in those areas to begin to create some beachheads, and also then in the redevelopment areas, and these might be some core areas where you can not just sprinkle opportunities, but create a real starting point for the community. Infrastructure improvements maybe need to be addressed, including stormwater, drainage, and so forth, but they could be great opportunities to radiate out from. Yeah, in fact, most communities are in, and in fact, it's not unusual for us to even see older than that, especially in communities that are smaller than Salina. But that median home range in the 60s to 50s, I mean, we have so much housing stock that was built as that kind of or post-World War II era GI built, GI is coming back in construction for that. It's actually an interesting question that they're beginning to look at a little bit more on the national level. How do we deal with a lot of these homes built in the 1950s, smaller homes, maybe don't have attached garages, and Salina has a lot of that inventory here too, like a lot of communities. Are they still meeting the needs of the modern buyer? How much updating do they need? I know I saw a talk given by the planner from San Diego area. He's the head of the American Planning Association right now, and San Diego is actually doing a big push on that because they've got a lot of that housing stock built in the 1950s, smaller footprint, no garage or just a carport or detached or single car garage. And how do we begin to make sure those houses are rehabbed, or do they need to leave the market? Have they met their lifespan? A lot of them were built pretty quickly and cheaply at that time. So how do we begin to deal with that housing stock? So that's not unusual to see that range in the 60s or so forth. It's the newer suburbs a lot of times where we see that number getting closer to present day.